It looks like it doesn't matter what we invest in. Everything moves in the same direction at the same time anyways. What we've got over here is the S&P 500 in green, the Nasdaq 100 in blue. So regular stocks versus technology stocks. There is a long-term clear winner though. Have a look at this. Once we zoom out, technology stocks tend to do much better than the S&P 500. Have a look at this here. This is now technology stocks compared to S&P 500 stocks. The chart is very long-term. It starts in 1985, and since then they outperformed by 470%. We've got a boom and bust cycle over here. That's of course the dot-com bubble. But what's also interesting about this chart is that the current AI bubble doesn't seem to be accelerating price development as quickly as we saw during the internet boom. We are just in line with our general growth rate. And so the straightforward takeaway from those charts is, let's just buy technology stocks. Let's forget about the S&P 500. But not so quick. I already see how some people might be saying, how are you not diversifying? If we suddenly see this tech crash, as you've seen in the past, suddenly all your money is gone. Now here's the catch. People misunderstand diversification. People think that if we just own more stocks, we are diversified. But as we've seen at the beginning of this video, there's just a lot of correlation within the stock market. Things go up and down at the same time. Yes, there is a clear winner, but when we've got bad times, both assets, so regular stocks and tech stocks, they're both going down. So there is very little diversification benefit, very little risk mitigation by buying many assets within an asset class. So if you buy 100 different altcoins, we're probably not going to do much better compared to just buying Bitcoin. If we buy 500 different stocks, we're probably also not going to do much better compared to just buying the best technology stocks. When we buy 500 houses, we're probably also not doing much better or much different rather compared to just buying 1 or 2 houses. All those things move in the same direction at the same time. The correlation is within the asset class. It is not across asset classes though. So if we want to diversify, what we want to do is we want to buy different asset classes. We want to buy some precious metals, some property, some crypto, some stocks. We don't want to end up buying 500 different stocks. We want to buy the best in every asset class. We want to mainly own Bitcoin and crypto. We want to mainly own the monopolies, the tech monopolies in the stock market. That's how I personally think we can beat the average investor. Hi, my name is Gerhard. I've been in the investment game for the last 8 years. I hit my first million 3 years ago. And in this video, I want to share the approaches that I use to outperform various markets. For crypto, for example, I've outperformed buying and holding Bitcoin by on average 2% per month over the last 5 years. The data is 100% transparent. It's on the website. It's linked down below. This is my monthly alpha versus buying and holding Bitcoin. This is then how that looks like over time. And I am, of course, also sharing my trades in real time. And here is that track record. All of my trades 100% public once they are closed. I don't know any other influencer on YouTube that's willing to share that so transparently. But this video is about the stock market, not about crypto. So let's have a look at the numbers. This here is Bitcoin Strategy Analytics. It's the backtesting platform, again, for the premium members. And we are going to run and return autocorrelation. What are we looking at? We are looking at the Nasdaq 100 relative to the S&P 500. Now, what is return autocorrelation? It's looking at the past return relative to the future return. So there is a saying, right? Past performance is no indication of future performance. But when we actually crunch the numbers, when we look at how much does past performance correlate with future performance, we usually get an inverse correlation. In other words, if an asset performed very well in the past, it tends to perform slightly worse in the future, and vice versa. If you saw a massive crash in an asset class, it tends to outperform in the future. And so when we run those numbers for technology stocks relative to the general stock market, we can make a prediction of how well it will do in the future given the performance in the past. And that's what we are doing over here. Now have a look at the following. On the x-axis, we've got the past performance. On the y-axis, we've got the future performance. So again, we're just looking at the entire price history. We look at past performance versus future performance, that pair, and we move this across the time series. And what we notice is an inverse correlation. When things have been very poor for technology stocks, they tend to do really well going forward. When tech did extremely well, it tends to do not that great going forward. This is again the relative performance. So the Nasdaq 100 relative to the S&P 500. So after a crash, of course we want to buy more, because then in the future we perform better compared to when we already had a nice run and then enter the market. We don't want to buy the thing that's hyped. We want to buy the thing that nobody believes in. When we look at that outperformance, right, the Nasdaq 100 relative to the S&P 500, and we measure 2 data points, check how steep is that slope over here, we get a result of 5.1%. So over the decades, technology stocks tended to outperform the regular stock market by 5.1% per annum. This does compound quite nicely, but again, we don't necessarily want to buy after a massive run up. And we have come up quite a bit. Not as quickly as we did during .com, but we are definitely not cheap. We are close to the all-time high. And so that then poses the question, if we hold now technology stocks, if we still buy in the height of the AI bubble, what could be our long-term expected return? We want to buy technology stocks, but we don't want to buy them when they are overpriced. And so that's what this analysis is for. This is where we are currently at. Now, I have not talked about how big our windows are. So when we compare the past performance to the future performance, we have to decide, right? Do we take the last 1 year to the next 1 year, or do we take the last 2 years to the next 2 years? Where is actually that correlation the highest? Where are those data points here the closest to the regression line in orange? And I've actually optimized that. I've tried to find the best time window based on the highest R square. And here the R square, by the way, is 0.9. It is very, very high. And this is the time window analysis. The best time window historically has been 14 years and 23 weeks. So 14 and a half years roughly. That's where the correlation is the highest. We look at the last 14 years, we look at the next 14 years. That's what this chart here is showing. And when we take this data point and we actually crunch the numbers, this is what we get. We should expect an outperformance of tech stocks versus regular stocks over the next 14 years of 74%. That means annualized every year on average 3.9% per annum. If our time horizon is 14, 15 years, and we are truly investing for the long term, we should expect more performance with that additional risk that we take on. And that additional performance is 3.9% per annum. It is not as high as it used to be, as in historically we had our 5.1%. We are currently above average. We have performed quite well in the last years. Still, if our time horizon is long enough, we should be expecting 3.9% outperformance versus just buying the overall S&P 500. And again, don't think about this in terms of I am not diversified by buying technology stocks and not buying all those other sectors. We want to diversify across asset classes, not within an asset class. Owning too many stocks in too many different sectors is not going to do us any good. It's better to also own crypto, to also own property, to also own other things like precious metals. We want to own the best thing in the market. We don't want to own 100 different altcoins. We mainly want to own Bitcoin. Same is true for the stock market. We don't want to own a random electricity company or a random construction company or a random bank. We want to buy the companies that have a monopoly, that attract all the bright talent, that can solidify their monopolies. The technology market is very top heavy, so the winner takes most. And it tends to outgrow other markets over the long term. And so we don't have to buy all those different stocks. We can just buy the winners and ride the wave. All we have to do is be patient enough. We have to save in the right asset. This was just an introduction to a vast library of tutorial videos. This is where I share how I manage my money. This is also where I share how I actively invest. I don't believe in the common narrative. I don't believe that buying the S&P 500 is ideal. I believe that there is better ways, and the numbers speak for themselves. And so if you want to check out Premium, the link is over here. There's also a 7-day money back guarantee. So in case you don't like it, just message me and I'll refund you 100% directly to your credit card. No questions asked. If it's your first time here, feel free to subscribe as well. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time. Cheers.